Welcome everyone, and good afternoon or good morning, depending on where you're based, and welcome to today's webinar on Building Abroad, Tying Everywhere, where we'll be discussing financial stability for diaspora professionals and how to navigate finances across different systems and life stages. My name is Umar, and I'll be your host for today's session. So today's discussion is really about understanding how to build strong financial foundations and make better decisions across borders, and importantly, think about intentionality about long-term financial security. And so before we get started, I just want to hand over to Musa for a quick overview on SNS and JokkoHub, and then he will give a quick overview on what we're building, our strategy, what we've built so far, and what we're looking to do. So,
thank you so much, Umar. And I just can't say how proud I am of the panel that we've actually been able to gather here today. We have experts in various fields, and this really goes to what we are as an organization. So SNS, the Senegalese Network for Success, was created to kind of address a clear gap, right? And it is the fact that as Senegalese professionals, we accomplish a lot of things individually. So we're everywhere. We do a lot of good things everywhere. But that success kind of remains fragmented and under-leveraged as a collective force. So we have talent in finance, we have talent in tech, in healthcare, in public service. We have entrepreneurs that are building, big businesses across multiple countries. We also have a lot of students, so that next generation that is, seeking guidance and opportunity. But the issue is there is no centralized ecosystem to kind of structure that, a platform that brings all that together. So that is why the Senegalese Network for Success was created. We aim to kind of connect that ecosystem. We want to be able to offer and facilitate mentorship. So those of us who actually have, experience in their various fields can share that experience so that the whole community can benefit from it. We want to be able ultimately to support economic development back home in Senegal and abroad. So we exist to close that gap. And I think by building a global network that has real impact, we can make a difference when it comes to that. So SNS is a US-based nonprofit organization, but our mission is global. So we want to strengthen the professional and business ecosystem for the diaspora. We want, in turn, to create the largest repository of Senegalese professionals ever created. So basically, being able to have the largest database of Senegalese professionals that even our country could leverage for expertise. We want to be able to create some pathways for mentorship, for opportunity, and for investment, ultimately. We want to support those of us who are in the diaspora and also in-country development, because our reach should be making an impact back home as well. The way this works is that we have this platform that's called JokkoHub. So JokkoHub essentially is the digital backbone for SNS, and it operationalizes our mission by providing, professional networks. So think of it as LinkedIn, but kind of created to address just our needs. It has a learning platform, and this is extremely important to us because we want to provide our community the ability to improve and to grow professionally and personally. So we have a learning management system, essentially an online university where people will be able to take not only just professional development courses, but ultimately certifications that will allow them to become more successful in their careers. And we have, sort of a community hub where we can, connect with each other, sort of a private social network. So that is JokkoHub. So we need everyone to be involved so we become successful. And, it's JokkoHub.com. So JokkoHub.com. And I'd just like to ask everyone who is on this call that hasn't yet created an account to do so, so we can grow as a community. It takes about a minute to just create your account and be part of this growing community we're trying to build. But extremely happy to be here and extremely eager to look at this to listen to this conversation we're about to have with these experts. Right back at you, Omar.
Thanks, Musa. That's really helpful context, and it's great to see how SNS, JokkoHub are creating more structured way for the community to connect and I guess access to opportunities. And so building on that, we've really been fortunate today to be joined by a panel bringing complementary perspectives across investing, economic research, and tax and financial planning. So without further ado, first of all, we have Ibrahim Abba, who works in portfolio analytics at Saudi Arabia's Sovereign Wealth Fund, bringing a strong investment and asset allocation perspective. So Ibrahima, any starting words?
Thank you, Omar. Thank you, everyone, for joining the call. Again, happy to be here today, and then looking forward to our discussion. I know we have a pretty good, interesting subject to cover.
Of course, we're glad to have you. I think Ibrahima has undersold himself there. He also holds a CFA chartered holder, which is one of the most sought or most difficult exams to actually pass within the investment asset management industry. So great perspective to have him. It's great to have him today. And we're also joined by Fatima Mbop, who's an economic analyst at the Federal Reserve Bank of Philadelphia, who will bring her perspective around wealth gaps and how they translate into real financial outcomes. So Fatima, I'll pass over to you for some words.
All right. Hello, good morning or afternoon from where I am. I'm in Philly. Hello to all of you from wherever you are. And yes, like Umar said, I work at the Fed in Philly. I'm also a PhD student at the New School in New York. So my research really does focus on studying wealth gaps at the macroeconomic level. So I'll be talking about things from the macroeconomic point of view.
Thanks, Fatima. It's great to have you here. And last but not least, we have Chernofail, Managing Director in Tax at BDO USA, who brings a very practical perspective on financial structuring, planning, and avoiding common pitfalls. So, Chernofail, I'll pass on to you for a couple of words.
Hi, everyone. My name is Cherno. I am a Managing Director at BDO. Prior to working in tax, I was a banker for 5 years while I was in college. So my whole life, I've been in the financial services world, whether in banking or whether it's in tax. So most of my clients are in the asset management industry. So we help them with tax planning, with tax structure to maximize their return. So I'm very excited to join this panel. This is actually my second time. So I was there in December for the launch of the group. So I'm very excited to be back. And thank you guys for inviting me again.
No, thank you. It's great to have you here as well. I think for your background experience will 100% add value to the conversation today. Okay, so to kick things off, financial stability can mean different things depending on where you are, your backgrounds, and I guess the type of system that you're surrounded with. And I would like to start by asking each of you briefly, what does financial stability actually means? Maybe I will just start with you, Fatima, if that's okay. Maybe you can just give a quick overview on or your version of what financial stability actually means.
Absolutely. So I think it's right on time right now, right? Like everybody is complaining about high gas prices and the idea of there being inflation. So when I think of financial stability from the economic lens, I think of a system where everybody has jobs. So we have, you can consider like full employment. Most people have jobs. And we also tend to consider we don't necessarily have high inflation. So that means like everybody is able to buy what they need given what they're making. So just from I think purely Fed, and I should say all views are my own and not the Fed's. But yeah, so financial stability to me means low inflation, we can buy everything with what we're making, and we all have jobs.
Thank you, Fatima. 100%. I think everyone would like to keep the amount they pay for eggs to be the same over their lifetime. So I think we can all agree on that. That's interesting. And so from a practical standpoint, maybe if I just turn to you, to Cherno for a bit, where do you see people making mistakes, but also what's your view on financial stability?
Yeah, as Fatima mentioned, is financial stability is mostly about having a balance. So it's not about how much money you have in the bank, but we do have a lot of anxiety when you deal with money. So every single day we spend our time thinking about how we're going to pay our bills, how we're going to support our family, how we're going to buy a house. But financial stability is just having that balance where you are able to dominate your finances and your finances are not dominating you. So in the short term is having enough liquidity so that you can pay your bills, you can take care of your family, you can support your community. But the second aspect of it, once you have gotten from that survival mode to that stability mode, the next step would be to envision your future and your next generation and building system that would allow you, to support your community and also make sure that the next generation, our next generation will have enough knowledge, they will have enough resources so that they don't start from zero. A lot of times we came from Senegal, some of us were born here, but for a lot of us, we came here after high school or, while we were in high school when we were younger. So we don't really have a good understanding of what is happening in America. So for me, financial stability is understanding what the current financial system we have here in the US, investing a lot in education and your skills to understand what is happening in the broader economy and making sure that you are strong. Then when you have needs, they are being met. And I think unfortunately in our community, we go through periods where a lot of us experience financial turmoil, and there are systems in the US that are there that we can tap into to help us, grow, help us be strong. And I think my goal for financial stability is not just for me, it's just making sure the next generation, they don't have to go through the same thing and they don't have to start from the basement. So they start from the top and just compete with all of the other communities.
Thank you so much for that. 100% agree. Yeah. I think being able to invest that excess cash at a certain point when you've kind of come out that struggling or survival mode is extremely important on building those, almost like a layer of bricks, brick by brick, to kind of get to a point where you're financially stable. So thank you for that. And then last but not least, Ibrahim, about what does financial stability actually mean to you?
Thank you, Cherno. On my side, I will be probably complementing what Fatima and Cherno said already. I will probably foresee financial stability to be different to financial independence, because you can be independent financially, but again, when it comes to stability, I will see it in mainly making sure whatever saving I have, whatever money I set aside, stable in terms of putting it in a place or putting it in a kind of product that will help me to make sure in the upcoming future I won't be losing it. This is, I think, the basis of it. Making sure the money I have or any wealth I will be stable and then go to a different, let's say, economic cycle. For example, the situation we know we are living in currently, oil price going high, we touch on inflation and all these kind of things. And mostly, if I put my money in a bank or something, I want to make sure, let's say, the turnover we are going through is not impacting it that much. And then if I need it, at least I will be either able to get what I put in, or at least I keep having extra money based on whatever I put aside. So this is somehow the way I foresee financial stability. And I think it's not complement to what the other panelists already said about.
No. That's a very, very good point you've made there. I think to summarize what you've said, it's almost about that durability, being able to navigate these different economic cycles and different points in your life where your cash positions or your investments or the overall economic cycle that we're in, you'll still be able to stand up and say, I'm okay, and I'm still be able to build. So that's very important. Okay. So if we just move on to our first topic that we want to double click on, which is financial systems and literacy. So just to set the foundations, I think when people move across countries, maybe they come from Senegal to Europe or to the US or to Asia, they often assume financial systems work the same way. So maybe if I start with Fatima, from your perspective, what are the biggest differences people underestimate?
So I think I'm going to take it from just how different maybe the monetary policy systems are. So here in the US, interest rates are key, right? Interest rates kind of decide how much, when we buy our house, how much the interest rates are going to be. And all of that is tied back to how much the Fed, like what level that they peg interest rates at. And the level that they peg interest rates at funnels through the rest of the economy, such that when you take out a loan, that interest rate is dependent on the interest rate set by the Fed. If you put in money into your investment account, whether it be like a regular savings account, high yield savings account, or something that's a bit more fruitful for you. I guess that's all tied to the Fed rate. In comparison, and the Fed, like on the monetary policy, I feel like it has a very clear objective, and most people that understand how the Fed works to me, it's very cut and clear. Wealth is also how wealth grows is very dependent on the kind of wealth you already own. And so if you know the system, okay, like for example, I was talking to my dad about why he never refinanced. He still has a variable interest rate, right? But he's coming from Senegal, where these are things, or these are vehicles that he's just not. It was never part of the thing. Like, we buy houses in cash, and then you build as you have money. Maybe I think now it's much more different. There are loans and etc. But in his generation, that wasn't the case, or it wasn't as prevalent as getting a mortgage here in the States are. So already they're very just at the basic level, like how do I get a house? Those are very different ways, I think, coming into the U.S. and coming from Senegal. So it's very important to know what kind of system you're coming into, because if you don't even know, then how can you get ahead? Like, I think in my parents' generation, they didn't have things like Google or chat to like help guide them to do, like, okay, if I buy a house, this is what I need to do. This is the kind of loan that I should be looking for. I need to stay away from variable loans. Or if that's my only choice, at some point, I need to make sure I refinance. These are not conversations that they had probably with each other, especially because of, I think, how tight-lipped we are about finances in comparison to the US. Everybody talks about finances. I think not all the time, but people are much more open about it. People will tell you how much they bought this house for, or especially now, everything's online. So I think there's much more transparency, and two, just the financial history of this country is such that if you immigrate here, you do yourself a disservice if you don't catch up and learn what the norm is here, because it's definitely not the norm in Senegal. In comparison, I think in Senegal, everything, like, you don't rely on wealth being built, because you're kind of relying on your children giving you money and everybody else. Like, it's more communal. Here, it's more every man for themselves. And yeah.
Thank you, Fatima. I think you really made some really interesting points there. And just to summarize what you've said, it looks like the point you're directing to is we should really understand what we have access to, first of all, because that's going to differentiate between who has the ability to kind of build wealth and who doesn't. Am I correct in that sense?
Absolutely. And you have to also understand how to move, like the rules of engagement. If you don't know the rules of engagement in the US, I don't think you could go anywhere. And the rules of engagement here are very different from the rules of engagement back home. Like, I can't function in Senegal, but I can function here. So it just...
So excellent. Thank you, Fatima. I think those are really great points there. So that's interesting. Maybe if I just turn to Cherno for a second. So from a practical standpoint, and maybe building upon what Fatima just said, where do you see people, again, making mistakes on when they're navigating these systems?
I think Fatima summarized it very well about the rules of engagement. So Senegal, when you think about it on a macroeconomic level, we are not at the world stage. We don't really dominate in terms of, the economy, technology, a lot of different things we are lacking over there, because our society, we went through the colonial period and now we try to build our own country, but our system is still dominated by cash. And in the US, the difference here is that we move from probably one of the poorest country in the world to the richest country in history. And the level of sophistication that you have here in the US demand that you upgrade your skills, you upgrade your education, and you have to move really fast, because the other thing that we have to deal with is competition. You have people from all over the world coming from India, from China, from the US, and a lot of us, when we go to college or when we go to the workforce, we have to compete with those people. And when we go there, we turn left, we turn right. We don't see a lot of people that look at us, and we have to really fend ourselves. And sometimes it's a very lonely feeling. But the good thing about it is that if you are able to upgrade your education, you are able to upgrade your skills, you are able to compete with them. And one thing that also is holding us back is that we think in the mindset of we are still back home. So for example, when I left Senegal, I was 20 after high school. When I came here, the only thing that I was thinking about is getting an education and going back, buying a house. Like all of my plans were centered around going back home. So that kind of pretty much determined how I was investing, how I was interacting. So I didn't have really any long-term goals in the US because I thought that I was here temporarily. But if you study the history of immigration in America, most of the communities that come here, they never go back. I mean, a lot of us might have the idea that we'll go back to our family. But practically, I mean, my parents have been here since 85 when I was like 1 year old. So they still haven't gone back. They always tell me, oh, we're going to go back. Then they go to Senegal for 3 months and they're back. So I guess when you are here in the US, you have to, as Fatima was mentioning, you have to understand the rules of engagement. You have to understand how the economy works. If you're an entrepreneur, you have to understand how to raise capital, how to tap into those networks that allows you to grow your business, how to access to professional advice like the accountant, the CPA, the financial advisors. All of that, you have to be able to do it. If you are here and you have a young family, you have to figure out how you're going to move them into a decent neighborhood so they have a chance to have a good education, they are protected from violence and all of the problems that like some of our cities go through. And, you have to figure out what are the right zip code that you have to put your family so that, they are isolated from all of those problems that usually you see in certain cities in America. And also you give them a chance to have a really good education. So there are so many things that you can do. And it depends of your individual situation. But for beginners, for people that just came in here, the first thing you have to do is just know what's going on, understand how the US work, and you can get that through education. Right now, there are a lot of tools with AI that you can upgrade your skills. You can, get some AI agent that can allow you to learn certain fields. So knowledge is very open now. So everybody has access to it, but you can choose what you devote your time to. So you can devote your time into watching video or entertain yourself, or you can take that time every single day. You say, okay, I'm going to take 2 hours and I'm going to educate myself on, let's say, how to invest in an index fund, how the stock market works, how do I raise capital if I have an investment. And you have a network in the US that you can tap into depending on whatever you want to do in your life. And the other thing that's also very helpful is like organization, like this organization that you guys have, which is very helpful, is that even when I started joining, I started meeting a lot of people that I know they are here, but without this type of organization, you are not able to meet them. And they help you, guide you. They can give you mentorship. They can show you, because whatever you are going through, I'm not going to say you're not special, but you're not going to reinvent the wheel. Somebody has already done it. So instead of struggling for like 10 years trying to figure it out, somebody can guide you. Instead of doing 10 years, you can probably shave your time to probably 2. And time is extremely valuable. So that's one thing that I always say, is that I'm not saying we have to leave Senegal behind, but whatever mindset that we have built there, like when we come here, just throw it in the trash. We learn a lot of values, a lot of good things from coming to America. I'm not talking about values. I'm just talking about skills and how things work and being able to adapt to it.
Of course. No, thank you, Chana. I think adaptability is a key skill that not just the Senegalese, but I think a lot of immigrants actually they tend to kind of be stuck in their ways that they come from. And I think sometimes that can hold them back on moving forward. So I definitely recommend adaptability is one of the key points that will make sure everyone kind of takes on as well. And just building on that, so turning on to Ibrahima, once someone is set up in a system, how should they start thinking about accessing maybe financial markets or opportunities?
Yeah, thank you. It is, again, just complementing When it comes to accessing to finance specifically, sometimes people might think, I need to make X amount of salary, or I need to be as old, let's say, in my 30 or 35 or 40s to start thinking about investing, or to start thinking about setting money aside to buy a house or something, right? But I think, even based on my proper experience, I remember when I started my career back in Canada, we used to make a joke whenever you have new joiners, sometimes mostly Canadian, when they come first thing they're going to be thinking of is, okay, what kind of pension do I have into the organization, right? To set money aside. Is there any plan into the companies that will allow me to buy a house, probably, let's say, next year or the year after, or where I'm putting my money in? This is something that is interesting. Whereas us as, let's say, foreigners, or let's say immigrants, first of thing we think of is, okay, I get my money, and then you're going to be shopping around mostly to look for Western Indians, to send money back, this kind of thing. So we make this joke saying, why people are shopping for houses, you are shopping for buy. So this is thing to think of, and it's not, supporting our families for sure. And sometimes, like, having this discipline and accessing to investment is all about discipline, right? So saving at least a small amount of money to start, right? That is the first starting point. As long as you can balance between your needs and what you can support your family with, and not also think, okay, I need to maybe X amount of years to start thinking of it, right? So, and in different system, let's say, if I take the example of Canada, usually there is multiple type of system you can type in, right? You have from the company, if you are putting your money in, all the bonuses you can get every year, you put them into a kind of special account. You can use it as, let's say, for your mortgage to start at this financing your house, right? When it comes to investing, sometimes again, you don't need to have extra amount of money. As long as you are disciplined, you put a small amount of money, and then just put it in the kind of the products that is need to be in based on the term, let's say, you have. It can grow, and then you are building your wealth, right? And again, today we have a lot of tools that we can use. We can use either to learn, either to invest. So it's about also looking at those different tools, and accessing to the good tool, right? To the good type of investment you have to. So there is network. As this network, you can find people that can guide you through the banks you might also have. But I would say, I think the most important thing is just to start as early as possible, because when it's come to investing, and when it's come to saving, or let's say accessing to investment, the earliest you start, you're gonna get experience, right? But also, like, let's say, for example, it's all about life. For example, the younger you are, the more you can take different type of investment that can be riskier, but at least the payoff might be higher. The older you get, the amount of risk you can afford might be go down, and then so on so far, right? So what I would probably say again is all about knowing what's going on in terms of we touch on the different systems, the interest rate, or whatever type of tools you can have, but trying to connect with people that can help you, and then accessing to those type of investments. There is multiple type of investment. Some of them might require, let's say, maybe to be a little bit wealthy. Some of them might not specifically, right? But the discipline is a key for this kind of thing.
Thank you, Brahim. I think you've summarized it there really well. I think starting early is very, very important. In asset management, they tend to say timing the market is better than timing the market, right? So the earlier you start, the more you spend kind of putting cash towards some of those products to build wealth, the better it compounds, and the less likely that, some of your investments might go underwater. So thank you for summarizing that. Okay, and if we just move on to next point, I think this is a very important topic we should discuss today, which is credit. So credit is something many people only tend to realize important when it's too late. Why does it matter so much in developed financial systems? Maybe if I start with Cherry.
Yes. Yeah. So actually, that's a very important topic. Before, when I was in college, I went to college in New York, so I had a job as a banker. So I was banker for 4 or 5 years, and I think those 4 or 5 years while I was doing my bachelor's and my master's were probably the best years in teaching me about money. Because I work in Harlem, and one thing that I noticed is that I used to have a lot of. I mean, it's hard to miss me. I'm dark skinned and tall, so when they see me, they say it's a Senegalese guy. So we're gonna go to him and ask him for help in terms of financial needs. So we have a lot of businesses. We used to work with a lot of restaurants. We used to work with a lot of Senegalese that want to buy property. But the issue is credit was always a problem because, first of all, we have two problems. One was people that don't build credit. So they say, I'm not going to have any debt. So I'm going to operate like we are in Senegal. So if I need something, we use cash. But the thing is that there are certain investments that you want to do in the US. Cash is not going to solve it. If you want to buy a house, I mean, the average house in the US costs more than $400,000. If you live in New York, I mean, good luck buying a house for $400,000. So the time that it will take you to raise that money is a very long time. So the only thing that can help you get there is credit. And credit is the bank will look at your financial history. There is a score that they will give you. And if you, what they will do is that two things that credit try to measure. I mean, it does one thing, it's just it measures risk. Like if they give you that loan, will you be able to pay it? And the bank, they don't know you personally. They just look at your financial history that is published in the credit report. They will look at your debt to income ratio. So let's say you make $10,000 and you are $11,000 in debt. They're probably not going to give you anything. If you have a lot of collections on your account or you haven't been managing your finances and paying things on time and you are late on your bills, they weren't likely to pay. So a lot of time when I was working in the bank, that was some of the issues that we have. And it was kind of unfortunate because one thing that I like about the Senegalese community is like, it's probably the smartest community that I know. Like wherever you go in the world, you will find a Senegalese guy doing some pretty impressive stuff there. But I think two things that we always have is that business. Sometimes when you want to borrow to buy a house for your children, like you have a lot of collections or you haven't really have a good financial history that allows you to borrow from the bank. And the history of the US is the history of leverage. Leverage is just a fancy word for you being able to do something your own means wouldn't allow you to do. So you have, let's say, $40,000. You want to buy a house that costs $600,000. So leverage, how do you get that leverage where you are able to buy that house for $600,000? Is that you have to be able to build strong credit that would allow you to do that. The other way that credit works is that some of you go to college and sometimes the degree that you have, if you want to go to like medical schools or like engineering schools, those are very expensive. Sometimes you need either you or your parents to co-sign on the line. Guess what happens? If you don't have the good credit, you can't go. We don't necessarily build the network. And the other thing is that financially, if you don't build that credit, sometimes when you want a business loan to scale your, so I think everything, the foundation of the US is built on credit and on leverage. And I think we have to really educate ourselves. I mean, I have make some mistakes in credits when I came here. When I first thing, I think one of the mistakes that I make is that sometimes somebody might come and say, oh, I need to, co-sign on something. You're like, okay, it's a good friend, let's do it. Then you do it. And a few years later, you realize that's not something you're supposed to do. So there are a lot of pitfalls when it comes to credit. But I think if you want to build wealth in America, I think credit is extremely, extremely important. Once you ruin it, you cut yourself from leverage and you limit yourself. You limit yourself from getting money for a loan. You limit yourself from education, and you limit yourself from housing. And if you have a business, if you want to expand, you limit yourself from getting a loan for the business. So it's pretty much the foundation of financial freedom. We have to educate ourselves on.
Of course, agreed. Thank you, Cherno. I think understanding that it is something that is part of the developed financial systems is very, very important. So, and maybe if I just bring in Fatima here, the differences in actually who has access to credit and how that affects financial outcomes.
Yeah. So in my research, I look at a lot like the wealth disparities between Black and whites in the U.S. And of course, I think it's not a shocker, or it shouldn't be, that whites usually fare well. And I think it's because they have wealth. They have generational wealth that they're able to tap into and leverage. And so because of that, they can access better credit. And there's been, just so much research about that shows even where you live will determine the access of credit that you have, right? Like if you live in a poor neighborhood, even if you have like a good credit, you might not, they're gonna like discount you before you even walk in the door. So it's crazy that credit is so important in this country, and how you leverage it and how you show up, it will determine like not just your life, but your offspring and their offspring. So understanding the system and being able to not just access credit, but access it, I think, responsibly. And then when you access it responsibly, to make sure that you can grow with it, and you're not just like my baby sister. I wanted to punch her in her face because she got a credit card, and I was like, well, are you paying it off? She's like, no, I don't have the money. I'll pay it. I was like, have you not been listening to me? So it's like, it's things like that. I think when I look at the data and I compare like white families versus black families, I think one, they've had access to credit for many years. So they've had time to learn and perfect and pass on that knowledge to their children, right? And having a lot of wealth absolutely helps. Like, so it's really important. I think sometimes we don't realize, yeah, maybe in your mind you're coming here to live for just a couple of years and you're going to move back home, but those couple of years usually tend to turn to 40 plus years.
Yeah, thank you, Fatima. 100% I agree there. I think understanding that way you have access to it, again, how you can use it and how credit can help you build on those bricks, then I think it's very important. So if I just turn to Ibrahima, maybe from an investment perspective, how do you think about debt, and when is it useful and when does it become a problem?
Yeah, I think when it comes to investment, investment always come after debt in the sense of personally. I'm not into the term of corporate or let's say institutional, but personally, usually people might think of how I clear my debt first before investing, right? But in reality, both of them can go hands on hands in the sense of, it's again all about, right? So whatever type of debt you have, as long as you can have it and it can be manageable, I think is a key here. So having a balance of debt that is manageable, you are able to pay back, when it's come to credit, usually, I think the discipline there is actually at least to make sure you are paying back your credit at least the minimum amount that is required, because that is what helps you actually to build up your credit. So this is something that might not be aware of usually, because our system in Senegal or many countries, they don't work like that. Even in France, for example, credit has been probably growing recently, but in the past, it's not something that you have in France, for example, compared to North America. All right, North America, they are very keen on those, and this is actually what build your financial history, right? Now, when it's come to investing, again, it's a balance between those debt, and it's not because you have debt, you will be setting yourself outside of the investment system, right? You can use both the minimum you have, again, as long as you can set some amount of money aside, because this investment will also be what you will be needing, let's say, if you need to go to school, or if you need to fund your house or something. So in all case, you need to look at it in those two lenses. Make sure you are building up your credit properly and have the right credit amount. And in parallel, you also need to think of investing, because again, this amount of investment is going to be something you will be using for multiple reasons, right? We are talking about education. We're talking about, let's say, even for your kids or for their upcoming schools, for university or something. So you cannot, let's say, go either one side or just investing without maybe building up your credit. You cannot also just like being focused on your credit without looking at investment. Now,
Yeah.
it depends on which level you are, even into the investment world. Sometimes you don't need, it's for sure it is a little bit more sophisticated when we're talking about leverage, these kind of things. Let's say it depends on which level you are in your life and which amount of wealth you build. Even in the investment world, there is always different type of product you can use. Sometimes, like you even don't need to put your own money to invest, right? There is multiple type of leverage you can type in to use them and then invest as long as you are making the good decision. I don't want to go, let's say, deep into that kind of thing because they can be risky and then it requires a lot of knowledge on that part. But in general, I would say, credit and let's say go with investment. So you need to look at them.
Yeah, no, I totally agree there. Thanks, Ibrahim. I think just to summarize this section, just because you are or you have a couple items that you have to pay for doesn't mean you can't invest. It's better to start early, understand your access to credit, find the products you understand properly how they're allocating, type of risk they're taking, just so you understand as well how that portion you're putting aside to invest is going to be affected over a different economic cycle. So thank you for everyone's input on that. And so if we just move on to the next session, which is about investing and financial planning, there are just a couple of points that we should maybe dive into a little bit more. So maybe I'll start with Ibrahima again. So a lot of our members, they earn abroad, and some of them, they think about investing back home, but they also want to invest domestically. So how should they think about this balance, maybe from a allocation perspective or standpoint, global/local?
Yeah, when it's come to that again, it's all tied back to them. As us as immigrants, we always have this link to back home, and usually when we look at either investing, buying house or something, you might see a lot of people before they buy house where they live, they might maybe think of buying house in Senegal first, right? And then they're gonna be probably thinking of it. It's similar way in terms of investment. If you can for sure invest now. Luckily, we do have, let's say, a strong financial system that is somehow global, right? You can be in the US and then invest in Senegal, but it's all depend on which type of investment do you want to make, right? You're looking at in terms of, let's say, family-oriented investment, or let's say helping, or let's say building some kind of business in Senegal, which is can be tricky if you are not if you are not there. Or are you looking at in terms of like you have the amount of money you want to invest in, let's say globally in terms of, let's say, either accessing to stock market or let's say debt or any other thing, right? Maybe I will probably go into, let's say, the sense of, okay, you have amount of money either through your saving or through your retirement that you have, and then you have the flexibility to invest that money globally either through the country you have. But maybe the first point just to say are they don't just put all your egg into the same basket, right? So you are in the US, your wealth is highly correlated somehow dependent to the US. So if you have extra money to invest or let's say to make grow, good to have it like part of it in the US, but diversification is a key. So when I say diversification, think about like investing in other countries, right? If you have access to the stock market, invest in the US for sure because the growth is there, the technology is there, but also look at it in emerging market, for example, other countries where actually there is a lot of opportunities, right? When you invest in Senegal, there is a lot of access to different type of product. It can be debt that has been issued by, let's say, the government, right? It can be other type of projects that people are backing in where actually you can make amount of money, right? But again,
Right.
it's all about diversification, like looking at different type of opportunities. And then, but one other thing actually is very, very important when it comes to investing, either locally or globally, is to make sure you are assessing the risk of the investment you are making, right? Because again, there is nothing that helps us like when you lose the entire money you save for a lifetime, right? So
Yeah.
assessing this amount of risk is also very important. Now you have different type of product you can type in, right? If you are, let's say, if you are young, you have ability to take more risk. Maybe you might be more willing to go through some product that are, let's say, more risky, right? And so on so far. So these are kind of things actually you need to consider. But again, maybe to summarize, risk assessment is a key. Diversification is another thing that you need to look at, and also the time horizon you have. Let's say an investment that you're going to be making for let's say to get your money back in 1 year might be completely different to an investment you're going to be making to get in maybe 20 years or whatever time horizon you get. So these are actually the main key point to consider when it comes to investing either locally or globally, cross border.
Thank you, Brahima. I 100% agree with that. I think understanding that you should allocate maybe to different regions or different asset classes is very important. I mean, they tend to say the wealthy earn a bit of everything, right? So I think just to summarize it, that's how you should really think about it. But first of all, always do your due diligence, understand what you're going into, the risks, your investment horizon, your objectives, and kind of really understand like how long you're willing to bear this for. So thank you for that. And if I just turn into Fatima, so how should people think about maybe inflation when it comes to investing?
I think you can. It'll determine when you invest and how much, right? So if COVID, I think, is a great example. And we can compare COVID and the 2008 recession and compare housing prices. And so in the COVID, what we saw, at least in the U.S., were the prices of houses were just, people were inflating it, and they were inflating it, and I'll explain how they were inflating it. Everybody was working from home, and at least in big cities, they decided to move from the big city to like the suburbs. And there were a shortage of houses now, because now there's a huge demand in people wanting these houses, but the houses weren't being built as quickly as to keep up with demand. So what were people doing? They were enticing the sellers to give them the house by offering them more money, right? So maybe once a house that was worth $300,000, you get into a bidding war. You're like, no, I want this house more than you, and I have more money to spend on this house. And why do I have more money to spend on this house? Because I have more wealth than you. I have more financial assets that I can throw at the seller. So we saw like people buying houses over $100,000 over the asking price. So if I sell the house for $300,000, it was getting sold for $400,000 because people had that amount of money or that amount of wealth that they can throw at it. So right there, inflation, we saw it. It was very clear. And it took some time for housing prices to get back down because people were starting to run out of money. Or demand was catching up with the housing prices. In comparison to the 2008, it was a completely different story. You had people buying houses because they were offered loans that normally they shouldn't have been offered. Like people were getting loans for $500,000 when they could only afford a $100,000 house. And since then, there have been safeguards put in place, but that was a different kind of inflation. Whereas that, I think, once there were protections in place to protect the consumers, it like immediately kind of shut up, and then we had that recession. In comparison to COVID, it tapered off because people stopped spending as much. But to me, I feel like housing prices kind of stayed at that level in comparison to the 2008 crisis, where housing prices completely plummeted. A lot of people, when they couldn't afford their payments, ended up having to foreclose their house. And so I think, really sit and think about the time period you're in. Is what I'm buying worth it? Do I have extra money to invest right here, right now, in this high price? Like gold is another great example, right? Gold, we saw over the past couple of weeks, the price of gold was just like skyrocketing. Would it have been smart to buy gold then, knowing that at some point the price of gold is going to come back down? Like, these are the things I think you should think about. Do I have the money to invest? If I invest at this high price, am I going to get paid? Like, don't think just right now. Think of like, I think in Senegal, we tend to think of, yeah, right, like God will fix it. In comparison to, I think here, we really consider, okay, if I do something today, how will it affect not just me 10 years, but how will it affect my children and my grandchildren, whether or not I can pass on that wealth. So I think consider that.
Thank you, Fatima. I think it's definitely true. You know, a lot of people say yal bahana, which is true, but you should also tie your camel first, right? So that's something that everyone should probably keep in mind. And maybe if I just move to Jennifer, just to close off this section. So how should people think about structuring these investments if they were going to do it locally or back home?
That's a very interesting point. I think it depends of your financial objectives. The US has a unique structure that there are a lot of structures that are available in the US that are not available in Senegal. The financial market that we have here and the leverage tools that you can tap into and the investment networks that you can tap into, they are not available. But in general, what I always see is that there are a lot of projects that you want to invest in Senegal. They need a lot of liquidity. They need a lot of cash. And there's also a higher level of risk. Generally, I wouldn't say it's safer to invest here, but a lot of investment in Senegal, even when you look at like the biggest driver of investment in the US are the institutional investors. These are pension funds. These are wealthy individuals. They pool their resources and they have a larger amount of capital that they can deploy. And that has a bigger impact in terms of creating jobs and creating a lot of wealth. So those networks, I mean, we kind of have similar networks. I think the most elemental network that we have in Senegal, that's what you call tontine, or like association, where people pool together resources to invest on a project. On a smaller level, people can see the impact of it. But a lot of times when you go back home, pooling those resources, making sure that, if you have American investors that need to go to Senegal and invest, there are certain regulations and rules that they can follow. For example, you have a lot of institutional investors that want to invest outside of America because the market is saturated, so they want to, have returns elsewhere. So they went to China, they went to India, they went to all of these emerging markets. There are a lot of places that they go to in Africa, but a lot of times they invest mostly in toll roads. They invest in trains. They invest in roads. They invest in infrastructure that are really guaranteed by the government. So a lot of times, let's say if you have entrepreneurs in Senegal that somebody want capital from the US, it's very complicated to get the money over there because you have certain legal requirement. The US has some very strong anti-money laundering rules. A lot of the wealthy investors, so the network in Africa in general. I mean, I see some of them building it in certain countries, but it's not really built yet for the money or the institutional investors to go there and pour some money. I think the benefit would be is to like when we go there is to create certain networks that certain institutional investors can tap into it. So there are a lot of ways we can do that. One way is to create an investment company. And the investment company, when you have it back home, is that you are going to create a structure. You're going to have a network of lawyers, accountants, financial advisors that you can identify certain fields. Let's say if you think that, the mining industry or the oil industry or the entertainment industry can benefit from a good infusion of cash. If you are able to build those networks there and make it an investment grade, you can probably attract a lot of institutional investors in terms of bringing money. Or even if it is not institutional investors, it's just like regular people that can create a fund, and everybody for like 1 or 2 years, they're contributing money up to where they have a huge amount of capital and they can target investment back home. Because what I usually see is that a lot of people are doing things individually and it doesn't really have the impact that it should have. So it's just you, one person, your resources are limited. You are struggling to pay everything that you're supposed to pay here already. Then if you want to make a change over there, it's like you need a lot more effort. You need a lot more people. You need a bigger network and you need a lot more capital
course.
to do that. I think that's where I see the issue. The other things about the structures, those, they can be sorted out. You can figure out, because a lot of things also that comes into play is, the legal requirements, because sometimes if you have to move large sums of money across border, there is going to be a lot of scrutiny. So you need some legal protection there. In terms of taxation, you want to avoid double taxation where you will have tax in Senegal and tax over here. They have treaties. So there are a lot of things that you can use. They have a lot of support system here that you can use. But I think sometimes what's missing is just having a pool of investment from a large network and taking that and having leverage to go there and invest and guarantee better success than if you are doing it individually.
Agreed, 100%. I think there are definitely some barriers into pushing capital back home, and maybe doing certain items early, as in your early years of investing, might be a bit easier domestically. So 100% agreed. I think also you made a really good point there. Some of the capital that these people save, actually, if you probably accumulate or group or aggregate a lot of that capital based on those people who are on the diaspora, you're probably reaching the millions, to be totally honest. And we can probably do a better job at, bringing everyone together, all that capital, and maybe managing it in a better way. And that's something JokkoHub also, or SNS also plans to do in the future, which is maybe to perhaps put together some sort of investment fund that groups a lot of this capital that can be distributed into different business ideas or into different sectors that can make impact at scale. So those are definitely really, really good points. And just to kind of bring it all together, the last point we want to talk about today is long-term planning. So thinking about life planning and maybe planning for your kids, or maybe planning for retirement, or maybe planning for marriage for certain people, or maybe planning for maybe even a holiday, right? So a lot of people delay long-term planning if you think about it. But realistically, you should start thinking about long-term planning early. Maybe if I just start with, so from a wealth building perspective, what does long-term planning or long-term investing look like?
All right. Again, it's all depend on your life cycle, where you are at, right? Are you just a new graduate from university and then looking at it? Because that's where usually actually we lack this, let's say, this thinking of long-term planning, right? Or are you in the middle looking for, for financial stability, or let's say at the end of your somehow life cycle, or so. But when it's come to long-term planning, every type of investment can be planned in the kind of long-term, right? So individually, you can look at it for yourself, for example, right? As I was saying, building your wealth and then planning it for retirement, right? And retirement need to be think of very early. You don't need to wait again, maybe to be the 50s or like nearby the 60s to think of retirement. You need to think of it very early, because that way actually again you have the let's say the possibility to recover from any loss, right? When it's come to other things, for example, saving for your kids for school, right? As we know, like the more we go, like more some schools, mostly the good ones, are extremely expensive, right? So you cannot afford, let's say, waiting for your kids to be, let's say, at high school and then start thinking of, let's say, putting money aside, or let's say saving for them. So it needs to start very early, right? Same thing when it's come to planning for house. You need, you don't need to, you even cannot wait 1 year before you want to buy a house and then start thinking of investing. So when it's come to investing, I think it's planning is a key, all right? And then mostly long-term planning, because again, usually either where you invest, either is through your own, let's say, business, right? Sometimes businesses are gonna go through different phases, like up and down, right? So you want to make sure through all that period you have enough time to face anything that happens, right? If you do something, you want to make sure you can recover from that loss, right? Similarly, into the economic, let's say, financial market, the same thing, right? Sometimes if you invest or you save money on through your for your pension fund, right, it can go up and then market can go up and down, right? But you want to make sure throughout the horizon you have, from this up and down, you are accumulating wealth, or at least you are not losing what you save, right? So similarly, for even travel, let's say vacation, right? I'm just looking at some flight tickets, let's say few weeks ago versus now. where actually, because of all this oil issue we have around the world, how things can change very quickly. And then some of the people I was talking, okay, some of them say, oh, I took my, let's say, tickets a few weeks ago before the war started. The price was very good. Now, summer is coming. People are planning to go to vacation. We have a shortage of even flight, right? Mostly us in the Middle East, here a lot of companies are no longer flying, so the offer you have is very limited, right? So, but again, it's all about planning. So long term might not mean years, but it's just like about what type of things you are looking at. But again, the earlier you start planning your thing, the better is can the output you're gonna have, either in terms of getting good price or get good return, or let's say at least balancing in between those different things.
Of course, no, planning early can definitely help you avoid certain headaches into the future. Understanding your future liabilities early, whether it is planning for kids or, like you said, for their university fees or whatever it may be. I think understanding future liabilities and then maybe scheduling a way you can have those investments, balance some of those off in the future can definitely help. And if I just turn to churn of files, so a lot of people delay long-term planning. So when, maybe this will be a similar answer to Ibrahima, but when should you start thinking about retirement and family planning in your view?
I think when you are very young, I think what I can start with what some wealthy people do is that they start teaching their kids how to plan for retirement when they are very young. And the way they do that is, I think the best, depending of your financial situation, let's say if you are started in, let's say you came from Senegal or you're young, you're 20, the best thing that you can do is to increase your earning potential, because that's going to determine how much money that you have, how much disposable income that you have. You can do that from, having an advanced education. So let's say in my field, I'm an accountant. So one credential that you can have is that if you become a CPA, there are a lot more opportunities there for you in terms of career growth. So when I was in college, I graduated, I had my 4-year degree. Then, I was getting a job and I wasn't really making a lot of money. And I realized that if I go back to college and do 1-year master and get my CPA, I can double my income in pretty much 1 year. So I just went back to school, did my master's, did my CPA, and, everything worked out. And I ended up, having a higher earning potential. And not with that, is that when you go through your job, I always look at who's the highest person in the company that you can aspire to. A lot of people in our field, they would just come, they work for an accounting firm for a few years and they get out. But if you stay and you keep moving up the ranks, you start as a staff, then you're a senior, then you're a manager, then you become a managing director, the next level is partner. It's just making sure that you keep growing within your field. And the reason why I keep emphasizing that is that it gives you a lot of liquidity. And with more liquidity, you are able to do long-term planning. So there are many ways that you can increase your wealth. One is a house. I understand that a lot of us, when you are young, it makes no sense to buy a piece of land in Senegal and tie all of your resources for the next 10, 15 years trying to build that house. It's just a waste of time. But there are better opportunities here. If you are going to live here, your family is going to live here, buy a house. On average, by the time you retire, your house is going to be worth 2 to 3 times whatever you bought it for. You're not paying rent anymore. You're paying yourself. And also, when you have a house, there are a lot of tax benefits. You can deduct the interest that you have property taxes. So pretty much if you buy a house, even though you're going to pay a lot more, there's a lot of tax benefit that you are going to reap from just buying a house. So you're going to pay less taxes, and that is more disposable income. The other things that can build wealth, if you look at the stock market in the US, since its inception, it's pretty much going at an average rate. If you look at, the S&P or the NASDAQ and all of these big indexes, they grow an average of 8% a year. And that's historical. So what you do is that when you start, go to whatever platform that we have, Robinhood or Fidelity or whatever platforms are out there where you can invest, just try to look at what is happening in the economy. So the US is always changing. So we went from the US in the 30s were dominated by agriculture. Then after the war, World War II, you have the industries, then you have services, and now we have AI. So what companies are going to drive the future? You can do your own research. There is also an element of risk that is involved. But if you are able to capture all of those companies that are going to determine in the future, you can start, placing small bets. If you have 1,000 here, you put there. If you have 2,000 there, you put there. For example, if you buy Facebook, started in 2010, like we all grew up loving Facebook when we were in college. So it was like $15 a stock, and now it's like almost, I don't know, 800 or 600 or whatever the hell it is now. I think what we don't do is that we don't really take a lot of risk in terms of investment. So early in your career, or I think there's an element of risk that you have to take in order to grow your wealth. So if you don't want to take risk, one thing you can do the indexes. The indexes just track the entire US economy. So if you invest in those, unless the US economy goes to hell, you are going to do well. So if the companies are growing, the US economy is growing, your money is going to grow as well. Fatima mentioned inflation, but on average, if you put money in your savings account, you're probably losing 2 to 3% every single year. Inflation last time they announced it was at 3%, which means that you're losing 3% of your money every year. So you have to be able to make sure that you shelter your money from that inflation. And the only way you can do it is, through indexes, through identifying investment. And a lot of you are very young, so you know what's going on in the world. You know what companies are driving. You see all of these AI companies. You have the chips like NVIDIA, AMD, and all of that. You have all of the infrastructure that's being built, like the memory companies. You have the energy company that are built to support AI and to support the next phase of the US economy. So if you're young, you have to look into those and figure that out. As you get older to retirement after 40, pretty much your mindset is going to change. You're going to have to focus on reducing risk, putting your money where in 20 years, you will have that money available. So depending on your age and where you are in life, you pretty much have to be willing to take risk and tap into those networks that we have mentioned before to grow your wealth. But I think for us, it starts very young. If you have children, start teaching them right now about retirement. We see a lot of time in our community, somebody stay here for 40 years and they're retiring. You couldn't buy a house, you don't have a house, you retire, you don't have any money. And when you go back home, it's very difficult. Or sometimes if you stay here, you are suffering, but you have to invest in yourself. You cannot be just sending money to Western Union or Sendwave or whatever that thing is called every single month. It's good to support people back home, but you have to invest in yourself. You have to invest in your future.
Agreed. Thank you, Chernoff. I think 100% understanding the access you have and what products are available is very important. And sometimes maybe you don't have the time to invest, or sometimes you don't know what the best asset class to allocate to is, or you don't understand the underlying risks. Because the financial market can be a very complex world. Sometimes what you can even do is maybe you can put that cash you have, excess cash you have on the side, maybe you can top up your pensions. So your pensions tend to be invested in the long term, and these tend to be managed by experts who understand risk, who understand markets, who understand different asset classes. So sometimes it's just about maybe rather than you doing all the work, just push it towards your pensions, and then that money is locked up for a number of years. It can compound over time. So that's also something to think about. And maybe just to close out this section, I'll bring on to Fatima. So how do these long-term decisions differ depending on different background, income, or economic environment?
I think it'll just, influence what kind of assets you have access to when you buy, right? Like if you come from, a low socioeconomic background, maybe you don't have as much financial assets. And when I say that, I mean like stocks, and things of that nature. Maybe you have a house, but maybe your house isn't worth $300,000 or whatever. Maybe it's worth a little less. So I think depending on where you are, you need to see, okay, this is where I started. How can I get to the next level? Is it that I need to get another house? How do I get the capital, get the house? Do I need, like Jenna, I think brought up a lot of points, like thinking about your education level. And a lot of the research just shows that if you're married, if you have at least a bachelor's degree, more often than not, you are setting yourself up for higher levels of wealth. Is it a for sure fact? Absolutely not. Nothing is for sure, but you tend to have higher levels of wealth if you're married and you have at least a bachelor's in the U.S.
Cool.
So I think these are things that you should think about as you're considering building wealth, not just for today, but for the generations to come after you.
So excellent closing points there, Fatima. I think you've summarized the discussion today really well. Now, I know we're above time. We've gone just over the hour, so we might be able to squeeze in one or two questions for the panelists. We'll keep it very short, so maybe just one or two sentences from each of you. So one of the very interesting question we've just had come in is, given low savings and unstable income, what realistic strategies can help people in Senegal start building wealth? Maybe I'll start with
Build wealth here or Senegal?
in Senegal.
Okay. Senegal is kind of hard to build wealth. So a lot of times I go there often. Sometimes when you want to tap into liquidity or you want cash, most of the time, if you don't have a piece of land or collateral, it's very difficult to do. But I think one thing that can happen, because Senegal, they have problems with liquidity. Even the government has problems with liquidity. They've been trying to borrow money left and right, and they are struggling a lot to get money. So even the government is struggling. A lot of the companies, I have worked with a few companies there to help them, but it's just the networks that you have to tap into cash is very limited. I think one thing that can help is to be connected to the diaspora, because the diaspora has a lot of liquidity that we can help. But over there, Senegal, the salaries are kind of low. The cost of living is rising faster than their salaries. So a lot of them are in a perpetual state of survival. So getting out of that need a huge infusion of cash. And I think one problem that we have in Senegal is that people don't really trust each other in terms of money. So it's very hard to collect money together. But I think if you tap into the diaspora networks, and those are the ones that can bring the type of liquidity they need to grow. But internally, the banks, they are terrible. They are just there to exploit people. The government is in a tough situation, and people, their salaries is not going up by a lot. Then you have inflation going up left and right with the war, oil, and everything. I think they need the diaspora. They need to be connected to the diaspora.
Yeah, definitely agreed. Thank you, Cherno. And that nicely brings us on to the next question. Maybe I'll go with Ibrahim with this one.
Yeah.
So how can we design a diaspora-led investment model that incorporates pooled capital, transparent governance, maybe data-driven decision-making to identify and manage different high-impact ventures in Senegal? So I think what this question is really trying to get to is, what can we do abroad in terms of maybe putting together an investment fund or tapping into liquidity, like Cherno said, to kind of reallocate that capital to high-impact ventures in Senegal? What can we do?
Perfect. Yeah, I think there is a lot of things actually that already exist, either here, let's say in the US or North America, that we can learn from, with different type of structure. One of the things that my work, again, I think this is one of the things that the network is trying to do, is just because putting money together is actually the key, right? Now it's going to be which type of structure you put in place, right? But let's say if in all case, if we had, for example, through this network, let's say a fund, an investment fund, right? That can work, where people actually gonna buy the share from the funds, and then that will be put together to invest in Senegal, or to invest in a different type of project, with a pretty good network of people knowing the field, and then having the knowledge in terms of investment, how to manage this type of structure. That will be the key, right? But again, this all can also go, let's say, in parallel with different type of partnership funds that can partner with local entities again, to build up different type or invest in different type of project. Currently in Senegal, we have a lot of let's say few entities that are keen to have this kind of partnership. Either they are, let's say, involved in a high, let's say, big project, infrastructure project. Some of them are a little bit lower level to invest in Senegal, right? But when we talk about impact, that exactly the kind of things we want to touch on, right? Either help building up, let's say, the ecosystem in Senegal to be, let's say, to grow, or even building infrastructure. So building up a kind of funds that can be used, and then where people actually will invest, they don't even need to send their money abroad, but through that fund, and then using this money to invest in Senegal, I think can be one of the key type of entity or structures that will be helpful to do this kind of not only impact, but also it's a saving as well, right? You're saving your money as long as you can recover it.
Thank you, Ibrahima. Now, look, we are just on the clock here, and I just want to summarize everything that's been discussed today. So I think the number one thing that's been clear from discussion is that, first of all, you should 100% think about investing regardless of your financial position. Because whether you're in debt or whether you have a lot of excess cash, the only way to go from in debt to being wealthy is to have a portion amount that you're willing to push aside to invest across different asset classes or different types of risk over the long term. And the second thing is to start early. Timing the market is better than timing the market. And the third thing is to think about long-term planning. Start early, think about retirement, think about whether you're planning on maybe buying a house or going on holiday or getting married or whatever your desire is in the future, start planning for it now. And just to close, I just want to thank every single one of you for attending today. Special mentions to our panelists, Ibrahima, Cherno, and Fatima. It's been a real pleasure in hosting everyone. And departing words from the panelists.
I feel like I didn't reiterate this enough. Research shows that buy real estate, whether it be here or in Senegal. In Senegal, I think be a little careful about how you do it, because we don't have to go into that. But I think buy a house, and then everything else you can focus on.
Thanks, Fatima. Or maybe any parting words?
Yeah, I mean, the only thing that I say is being adaptable. I think that's one of the best things that you can be, because things are always changing. The world is changing. Just be open to changes and, take some risk and live life a little bit. So, and you'll be fine.
Thanks, Chef.
Yeah. Maybe that's what I would say. Again, planning is a key, and you just learn also. Don't hesitate to go and ask people around, and then plan specifically. The earlier you plan, the better it will be for you. So planning is a key.
Thank you. If you haven't joined already, please go on to JokkoHub.com and sign up to our platform. And we look forward to hosting all of you again in our next webinar.
Thank you, everyone.
Thanks, everyone.
Yep.
Thanks.